Hey everyone, welcome back to Corporate Decoder, where we make sense of the financial jargon so you don't have to. In this video, we're diving into FuboTV's latest quarterly report. And let me tell you, there's a lot going on under the hood. So FuboTV reported their financials for the quarter ending June 30, 2025. And get this, they're calling themselves an accelerated filer, which is a fancy way of saying they're a pretty big deal in the public market. We're talking almost 342.5 million shares of common stock out there as of the end of July 2025. Yikes, that's a lot of shares floating around. Let's talk about what's inside this report. We have their balance sheets, income statements, and cash flow statements. The big number that catches your eye is their total assets, which are $1,192,1300. See how it stacks up against their liabilities. On the other side of the coin, their total liabilities came in at $792,000 and $27,000. Now, when you look at their shareholders' equity, that's the money left over for the owners. It's $400 and $359,000. So they have assets pretty much covering their liabilities and then some, though that shareholders' equity number is quite a bit smaller than their total assets. Now for the really juicy stuff, the income statement for the 3 months ending June 30, 2025. Total revenues were $379,968,000. That's actually down from the same period last year when they brought in $398,965,000. So they lost about $11 million in revenue. For the 6 months of the year, revenues were $796,500, so they lost about $11 million in revenue. For the 6 months of the year, revenue were $12,000 last year, so it's a bit of a mixed bag on the overall revenue front. A slight dip in the current quarter, but up a bit for the year so far. Subscription revenue, which is their main source of income, was $352,673,000 in the quarter, down from $362,932,600 last year. That's a drop of over 10 million. For the 6 months, it's up a bit from $736 million to $744 million. They say this is due to losing some subscribers, but they also increased their prices, which helped cushion that blow. Advertising revenue was $25,851,800, more drop from $26,285,000 last year. For the 6 months, it's also down from $53 million to $48 million. This seems to be because fewer people are seeing ads on their platform, and the money they get for each ad, or CPM, also went down a bit. Now let's talk about the cost of doing business, or operating expenses. Subscriber-related expenses are their biggest cost, and they spent $291,402,000 in the quarter. That's a pretty big drop from $326,499,000 last year. They're saying this is because they lost subscribers and some content deals expired. This is good news for their bottom line, as it means their costs are going down. Broadcasting and transmission expenses were $10,877,000, down from $15,173,000 last year. They've been working to make their cloud systems more efficient, and it looks like that's paying off. Sales and marketing expenses were $29,957,000, down from $35,883,000 last year. They spent less on marketing, and there was also less in stock-based compensation. Fewer marketing dollars might worry some, but if they're seeing good results from less spending, that's a win. Technology and development expenses stayed pretty much the same at $19,259.20, $1,949, cutting back here, which makes sense as they're trying to stay competitive. General administrative expenses, however, went up. They were $24,344,000 this quarter, up from $20,000 and $17,000 last year. A big reason for this increase is legal and professional fees related to that big business combination deal they announced earlier this year. All these costs added up to an operating loss of $5,999,000 for the quarter. That might sound bad, but it's actually much better than the $35,675,675,000 operating loss they had last year. So they are losing less money on their core business. But here's where things get really interesting. The other income and expense section shows a massive gain of $219,190 for where Fubo got a huge payout of $220 million from Disney, Fox, and Warner Bros. Discovery. This single event completely flipped their financial picture for the 6-month period. Before taxes, they went from a loss of 81,950,262,000 last year to an income of 182,262,000 last year, largely 26,000 for the 6 months ended June 30, 2020, 2025. A huge turnaround from a loss of 82,025, a huge turnaround from a loss of 82,001 farm. A loss of 82,001 to 22,026 months ended June 30 RT1 can become dollars 18,201 share. This all translates to diluted earnings per share of 0.46 pence for the first 6 months of 2025, compared to a loss of $0 last year. That's a massive swing. It's important to remember that big litigation settlement though. Without it, their core business is still reporting losses. Let's look at profitability more closely with gross profit. For the quarter, gross profit was $77.7 million and their gross margin was 24%. That's a huge improvement from last year's 12.6% margin. For the 6 months, it's also much better, 18.5% compared to 9.7%. This is largely due to those lower subscriber-related costs we talked about earlier. So on the surface, Fubo is becoming more efficient in how it makes money from its subscribers, even with a slightly smaller subscriber-related cost we talked about earlier. So on the surface, Fubo is becoming more efficient in how it makes money from its subscribers, even with a slightly smaller subscriber base. Speaking of subscribers, they ended the quarter with 1.4 million paid subscribers in North America, down from 1.5 million last year. And in the rest of the world, they had 0.4 million, which is the same as last year. So the subscriber count is flat to down. This is a key area to watch. While they're getting more efficient at managing cost, they need to start growing their subscriber down. This is a key area to watch. While they're getting more efficient at managing cost, they need to start growing their subscriber base again, or at least stop losing them, to really capitalize on those efficiency gains. Now, a major piece of their strategy and a big risk factor is this business combination they announced with Disney and Hulu. They're essentially merging parts of their businesses. The deal has a ton of conditions, like getting regulatory approval and shareholder approval. If it doesn't go through, or if it gets significantly delayed or changed, it could be really bad for Fubo, especially considering all the money they might have to pay in termination fees. This merger could be a game changer, but it's also a huge gamble, and a lot of their legal fees are tied up in making this happen. Fubo also faces a lot of risks related to privacy and data protection. With all the data they collect from us, they have to be super careful about how they handle it. Laws like GDPR in Europe and CCPA in California are getting stricter, and any misstep could lead to massive fines and damage their reputation. It's a minefield out there for data handling. And speaking of reputation, their stock price is all over the place. It's really volatile, meaning it can jump up or down a lot in short periods. This is often because of market sentiment, rumors, or even just how the platform is performing on social media. They also face the risk that a lot of shareholders will sell their stock, which could drive the price down even further. Many of their executives are also using trading plans which suggest they might be anticipating some stock sales. Now let's put on a Warren Buffett hat and look at the big picture. Fubo's core business, the streaming service itself, seems to be getting more efficient. They're spending less on content and transmission, and their gross margin is improving despite a slight dip in subscriber numbers. The big win in Q1 from the antitrust settlement was a massive cash infusion, which definitely helps their liquidity and gives them breathing room. However, the company is still losing money on its core operations. While the Disney-Hulu deal could be transformative, it's also a huge if it happens, and if they can integrate successfully, it was a massive cash infusion, which definitely helps their liquidity and gives them breathing room. However, the company is still losing money on its core operations. While the Disney-Hulu deal could be transformative, it's also a huge if it happens, and if they can integrate successfully, it was a massive cash infusion which definitely helps their liquidity and gives them breathing room. However, the company is still losing money on its core operations. While the Disney-Hulu deal could be transformative to change their trajectory, the subscription revenue is down slightly, which is a concern, but the improved efficiency in cost. That's our deep dive into FuboTV's latest report. What are your thoughts on their strategy and these latest numbers? Let me know in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more corporate real talk and for even more insights. And to join the discussion, check out our Discord community linked in the description. Thanks for tuning in, and we'll see you next time on Corporate Decoder.